Let's go live to Evan Lucas now from InvestSMART. Evan, good to see you. Not such a great day on Wall Street, and it doesn't bode well for the ASX when it opens. Even with this $18 billion stimulus package foreshadowed, might it soften the blow?
It probably won't. And look, I'll probably go and answer that in a different way. The government, and basically over in the US government as well, they shouldn't be concentrating on the markets. If they can start getting a handle on the economy, the markets will be a byproduct that will stabilise itself. So that's the way to look at it. Unfortunately, last night is now officially the end of the GFC bull run. So in the US, it's the longest bull run in history. That has officially come to an end last night, and although we've still got half an hour before the close, it will happen. They're down 5.9%, and that is well and truly below the 20% from their record high, which is around about 3 weeks ago, to where we are today. And that, again, what all of this is talking about, what you've been talking about for the last several weeks, and also this morning, is that what markets really can't grapple with at the moment is how to actually price the risk around this. They have no idea about the impact to supply. They have no idea about the impact to overall profitability, what kind of government support levels will actually do to slow down the loss of income is all part of why markets at the moment are in that free fall. And that, therefore, again, the way to answer all this is when does it finish? No one knows. And that, again, is why also markets are so turbulent.
And it's the end of the bull run in Australia too, right? And being a bear market, for those who don't know, it's when it loses 20% of its value.
Correct, or more. So that's right. We had that yesterday. We almost did it on Tuesday. We had an amazing turnaround to see the Tuesday movement where we opened up down 3.76% and ended up closing up 3.11%. That also in itself just sort of classifies my answer before is how volatile the market is that it is moving in both directions at levels that you don't normally see in normal trading. So yes, we are also in a bear market. It is the fastest bear market that Australia has ever seen in terms of the speed and ferocity that we've fallen. But again, as I said, I would highlight it's not about the markets at the moment. It's about making sure that the economics of our economy continue to sort of hold as close to the line as we possibly can. Don't know if we'll do it yet, but it's certainly trying to get that way.
It certainly is. ASX has had a bit of a, mixed week, you might say. We've seen a lot of red, then a bit of green. A lot more red today, as you've just foreshadowed. Let me ask you about the stimulus package. Yesterday we saw Donald Trump commenting and hinting about some stimulus in the US, and the market rallied on those words. Might the market rally when we finally hear from Scott Morrison today?
Probably not. And the reason I say that, our market is actually beholden to what's going on in the US. There is much more money flowing from the US side that is pushing us around. It may give us a boost, but in all honesty, it probably won't. And I'll answer the next part of that question from the other part of this now, is that obviously the whole targeting of this package, and you've already spoken to the Treasurer this morning, is around employment. And why I highlight that, yesterday we saw the Westpac consumer confidence numbers at a 5-year low. But what you need to look inside that is a massive collapse in confidence around employment, fell 8.8%. And the next part of that answer is also the same survey showed that the expectation around house prices fell 6.6%. And that is the next market to watch now. Part of the reason why we have been going quite nicely is the housing market has been booming, particularly in Sydney and Melbourne. If you look back at the GFC, the housing market was about 4 months behind the equity market and the bond market in the fall off. So this is the next question. If you are having confidence issues around your employment and the ability to service a mortgage, even with record low interest rates like we have, you are not going to go out and buy a house. So this is the next thing to now watch, is how much of an impact on the property market comes through as confidence particularly takes a really big hit.
Seems like quantitative easing is becoming more and more of a chance.
It is, and I think the person to really have a listen to, he was brilliant yesterday, was Guy Debelle. So he was presenting at the Business Summit. He actually basically told us what the RBA will do when that comes about. And he highlighted that it's not necessarily going to be classified like the US did of quantitative easing, where they said, right, we're going to buy $80 billion of treasuries per month until we basically find a floor. What he was suggesting is that they're going to actually have a target that they want around pricings of government bonds and also the money market. So it'll basically be an interest rate cut inside the market, is basically what he was suggesting. So they'll get to 0.25 of 1%, and then from there, what they'll do is they'll start buying the money markets and the bonds to get it to basically, let's for argument's sake, say 0.5% on the 10-year Treasury, which is the risk-free rate. So that's what they're going to try and do, is bring borrowing costs down to a price point rather than just printing money, putting $80 billion or whatever arbitrary number that it is, and then just seeing where the price goes. That was what he was saying yesterday, and that's basically what it will be. So it's not true quantitative easing, but it will be a targeted refinancing of underlying products to get, again, that borrowing and that ability and confidence to actually go out with cheap price by the RBA backing you up.
There's not a lot of things screaming confidence at the moment, I've got to say. Evan, thanks so much for your time. We'll speak to you soon.
Thanks, guys.